we go.
Good morning, everyone. Thank you very much for joining this discussion. You can tell this is a topical discussion when your 11-year-old daughter's Halloween costume is the ghost of Eskimo's future. A few weeks ago, the Intergovernmental Panel on Climate Change published a report warning that we're going to have to rapidly limit global warming to 105 degrees Celsius or risk catastrophe. And this is right at the lower end of the previous limit set in Paris in 2015. To me, this really begs the question as to whether ESG integration, as required by the UN PRI principles, goes far enough. Over the next hour, the panelists are going to explain what ESG means, discuss different approaches to implementing ESG, the problems with data and disclosure, and then we will finish by looking at what the future might hold for ESG for ESG integration. Please submit any questions you have to our panelists using the box at the bottom of the screen. We will spend the last 5 to 10 minutes answering these questions. I'd like to introduce you to the panelists for today. Richard Lightbound is CEO of EMEA and Asia at Robo Global, the creator of the first benchmark index tracking the robotics, automation and AI industries with an ESG tilt. Richard, could you briefly explain how you became involved in ESG and where your firm is most active in terms of ESG?
Yeah, sure, Justin. Thank you. So we started Robo Global just over 5 years ago, and it was really initially to invest our own money into this theme of robotics, automation, and AI. If you fast forward to where we are today, we have very much a research-driven index that we've licensed globally. That there's well over $3 billion now tracking the index. And there's really two things that I think are relevant here that attracted us to this theme. First of all, just the overall opportunity. I mean, clearly we are a generation who is watching advanced robotics leave the factory shop floor and enter the broader economy. We're seeing examples in hospitals, on farms. We're seeing it in our homes. It's driving our cars. So it's clearly an enormous opportunity, but all of the good and cool stuff is still ahead of us in many ways. But also there are a number of macro factors that really make this theme very compelling and sustainable. And one of them really relates to the fact that globally we have a number of very significant social challenges. I mean, we can talk about aging populations, healthcare systems at capacity, pollution levels, a lack of certain types of resources. And for us, really at its core, robotics, automation and AI is all about tackling many of these challenges. It's about bringing efficiencies and flexibility. It's about assisting humans' general well-being. So there's a very natural tilt towards ESG and SRI in terms of how we have identified and talk about this theme.
Thanks,
I hope
Richard.
That helps, Justin.
That does very much. Thanks, Richard. We also have as our second panelist Miriam Omi. She's Head of Sustainability and Responsible Investment Strategy at Elgin, the investment arm of L&G, which chiefly manages assets for external pension funds. Likewise, Miriam, could you explain your history to ESG and your firms?
Yeah, sure. So we are what you call a mainstream asset manager. We manage about £1 trillion sterling of assets, and we provide, as you say, money for pensions, other types of institutional and retail clients. And I came from a background of both sort of kind of falling into finance, as many people do, but really wanting to do something about environmental issues. And then about 10 years ago, realized that actually combining those two and providing sustainable solutions within the financial context could have a really significant impact. And I think market has really developed significantly in the last 5 years to a point where it's very, very exciting today. And I think talking about ESG sustainability investment is very much at the heart of what we do. And we think there's a lot more to be done in this space. So very excited to be talking about that today.
Thank you, Miriam. And the last member of our panel is Atri Heinsbrook, who is the Head of Responsible Investing at NNIP, which was previously ING's investment arm. Likewise, Atri, could you explain your history and your firm's involvement?
Yes, of course. Good afternoon to you all.
NN Investment Partners is an active investor, and we have a long heritage in providing specific, sustainable impact and ESG integration strategies, just as we do also with regular investments. And the interesting thing is, I was always intrigued by the business strategies companies have and how they sometimes take or take not certain environmental and social aspects into their business strategy. Because the interesting thing is, the business strategy is also their license to operate, how they've been accepted, how can they sell their products, how can they produce services. So for me, it's all about working in the financial services and working in asset management helps us to be in the place to ensure that we can put money to work in the real economy, and that we can take environmental and social considerations into our financial decision making. That's really what we need to do, and that's also why you should be working in the financial industry, to make sure that money can be used as a force for good.
Thank you, A3. And likewise, I come from a background in multi-asset product management, and there, a few years ago, ESG really wasn't touched upon. It was just covered by engagement. Today, that's not the case, and I've always been a sponsor of ESG issues within the firms I've worked. Now, if we move on to the first of our sections, really, what is ESG? And now, Miriam, I'll ask you this. We have terms such as ESG integration, sustainable investing, SRI, ethical investing, responsible investing, impact investing. These are widely used, but I suspect with slightly different meanings. Could you provide a high-level overview of what these terms mean and how you think they can be grouped?
Sure. I mean, just to say outright here, it is confusing, and I think we kind of sometimes shooting ourselves in the foot with so many acronyms and terminologies. But that's because it is relatively new. There's a lot of innovation going on, and there's a lot of legacy as well. So I think I'd like to break it down to two broad areas, just to kind of simplify it. The first area is people's choices, right? It's about how they choose their own investments, and that might be to do with their own values, in terms of, I don't want to put my money into tobacco or defense, or that I want to put my money into low carbon strategies, which is a thematic funds. So ethical funds is to do with sort of people's ethics. It tends to screen out certain types of companies, sectors, and then some type of sustainable funds and thematic funds might be more targeting the positive impact in picking companies that are providing solutions. So these are, you have to choose different funds for this, right? The second category is what your asset managers who's managing your money should be doing. And that's what I call ESG integration, stewardship, all this kind of things that is to do with finding financial materiality from looking at ESG. So, if he's saying that, let's say, a good well-governed board is a good investment case, or companies that are addressing climate change is a good investment case, that should surely be addressed by your manager. So I think a lot of the conversations on the stewardship side is how you should be choosing different managers depending on whether they are doing integration of ESG properly. So those are the two areas. Now the impact sort of kind of is a newish term. Well, it's actually an old term that we used to call microfinancing, things like that, that you can really target as impact investing. But actually it's now been broadened out to talk about all the funds that have kind of positive societal impact. Now, important thing is every investment you make has an impact, right? So it's very difficult to say what is good or bad impact. But with data and with the kind of narratives that are coming out of us, we are increasingly expected to show what kind of positive impact we can create through our different funds, and then reduce negative kind of impacts as well. So impact sort of is probably the newer side, which has less of a defined definition, but perhaps more exciting for some people.
Thanks, Miriam. That was very clear. Now, A3, become commonplace to say really that ESG is going mainstream. What do you think's changed to encourage this new emphasis on ESG? And is it regulations? Is it client demand? Is it a desire to mitigate risk?
Interesting that you say it's sort of the new emphasis, and that's exactly what it is. I mean, I'm hearing already for 15 years that ESG is going mainstream, and actually it's mainstreaming. It's like if you take a highway or a railroad, more and more people take the train. It doesn't mean that suddenly trains are becoming the new way of transportation. So we've always been there with ESG. We've always been taking care of these things, but finally, I think there is a sort of tipping point since the last couple of years that it's much more accepted. So to me, it's much more that clients ask for it, expect it, and also are happy with the answers they get. So asset owners have really driven the recent emphasis, as you pronounce it. And to me, asset managers are not, just like Miriam said, are much more willing to act upon it. Microfinance used to be the impact thing, but it's been extended to much more things. So for me, ESG is much more the new normal. It's the other side of financial analysis, and ESG as two sides of the same coin. So for me, that is the goal, really mainstreaming. It's really the new normal. This is how we should act and use our money.
Great. Now, thank you, Adrian. Now, moving on to the main topic, which is really how we implement ESG across portfolios, and we'll chiefly be talking about how we integrate ESG. Now, this simplified chart shows three approaches to implementing ESG factors in portfolios. Firstly, ESG integration, which analyzes ESG issues to understand whether investors are rewarded for these risks. Exclusion, which is used more in ethical portfolios or SRI portfolios. And engagement, which together with voting is a part of active ownership. Now, Adrian, again, turning to you, you manage both SRI portfolios and portfolios where you integrate ESG analysis. Would you add anything to this? Do you think it's a fair picture?
Well, it's an interesting picture. To me, what is integration and engagement should be much larger than exclusion. Exclusion is actually a sort of part of what your own stance is, what you do or do not do. That it gives away a stance where you can be found on the football field. But engagement and integration is the real essence of being able to do ESG integration. Let's have a sort of an example. It's not about exclusions are, in my opinion, like Miriam just mentioned, tobacco. And yes, we also exclude tobacco, but it's not that I want to boost about it that we exclude tobacco. I want to talk about that we engage with companies. And if we cannot engage with them or we cannot have enough improvements, then finally it comes to exclusion. So in this picture, to me, it should be much more bigger on integration and engagement. Exclusion can be smaller. And where it all comes together, that could be a sort of the way where do you want to go, and that can change over the years where the things come all together. It's a simplified picture. It gives a direction, but please be aware that integration and engagement should be much larger than exclusion.
Thanks, Adrian. I think that's a fair point. Now, Richard, your RAAI indices are not ethical as such, but they appear to rely or not SRI as such, but they appear to rely more on exclusion in implementing your ESG tilt. Can you explain your approach in implementing ESG?
Yeah, I think in many ways we've almost reverse engineered our way into this. So as I said earlier, robotics, automation and AI we feel has a very natural tilt towards ethical and sustainable investing. But but that said, we do employ a number of quality filters to identify these potential index members, and one of those filters involves applying our internal ESG policy. And really what we're doing here is we're looking at each individual company. I mean, we meet these companies several times per year. We've got very good access to them, and we're really looking for any human rights violations, severe environmental damage, weapons of mass destruction. So it's an internal policy. It is available on our website. We do subscribe to some external data to actually help us here. We work with Sustain and Analytics. And I think as Adrian was saying earlier, this for us was very client driven. 2-3 years ago, a lot of our investors were asking us for more details about our ESG policy, so we really formalized it. We actually made it a formal, as I said, filter in our member selection process. We have actually excluded a couple of companies as a result of the policy as well. So, we've got examples of it in action.
Okay, thank you very much. And Miriam, your new Future World funds represent really, I think, quite a new direction. Could you explain the approach you've used and also how you think ESG fits with the fiduciary duty of investors?
Sure. I mean, Future World is a series of funds across a spectrum of asset classes, but it's also a philosophy in terms of saying, let's create ESG funds that's very much a mainstream offering, that's good enough to be a default in the main bulk of the investments. That doesn't mean to say that you can't find, kind of concentrated funds that really looks for interesting opportunities. But for example, in defined contribution pension space, about 90 to 95% of the people just don't choose. So they're just in the default fund. So what's really important is that default fund addresses key ESG considerations in line with fiduciary duty. And I'm going to get to the fiduciary duty bit a little bit later. So what we did was look into basically really material issues like climate change, like key ESG considerations, and incorporate that into the equities or bond, kind of the main funds that become part of the default. And what that means is that the people are not choosing to be sustainable, but people can opt out of sustainable options. But in doing so, what's important is the returns don't look that different from the starting point. So what you see is that by incorporating some of those material ESG considerations, you ended up with a portfolio that looks pretty much the same from a return perspective and volatility and so forth. You get the same diversifications. You're not really compromising that. At the same time, for example, on carbon stuff, you can reduce exposure to carbon reserve by 80%, carbon emissions by 50%, and increase exposure to green revenue by 40% and so forth. So you can do a lot of innovative things within the default option, and that really started off as our range and a commitment to providing funds that's good enough for your future and good enough for your pension. So that's the kind of philosophy behind it. And the fiduciary duty part is very important. And I think a lot of people say, oh, I can't do ESG because it's against fiduciary duty. Well, it's very clear that where it's financially material, we should be incorporating ESG concerns. So not every ESG concerns is material. If, I don't know, let's say a company is putting some money into a charity that makes them look good from a brand perspective, I wouldn't necessarily say that's material. It's an okay thing to do, maybe, but that's not financially material. Whereas if you have a lot of carbon emissions compared to your peers, that probably means that you have a higher energy bills. That's a cost. That's financially material and so forth. So we really dug down into the components of the ESG that would have impact on companies' bottom line and the market as a whole. That's really important when you're creating large mainstream funds. And so what we said was, this gives comfort to the DC funds who are looking at the default option that is in line with legally the right thing to do from a fiduciary duty perspective, with the right types of returns, the right types of volatility and all the things that's of concern. And that has resonated very well. And a lot of younger people who are choosing pensions have different information today. If you say to them, look, you get pretty much the same return, but you can address a lot of those ESG things, and we think that's going to be good for the market. Would you like this option? It's kind of a no-brainer. So we'd like to change the dialogue with this series of funds that we have.
Okay. And I suspect I know what your answer to this will be, but do you think regulators should go one stage further and legislate that ESG considerations become an integral part of the legal fiduciary duty of investors?
I think in the UK context, it's been very clear that if it is financially material, it is part of the investment decision maker's responsibility. So in a way, it is already there.
Okay.
It's just that there's a lot of misunderstanding of ESG. But what we saw from DWP, which is Department of Work and Pension, is that now a lot of DC schemes and DB schemes have to articulate how ESG can have financial material impact on the investments. And so there's a big difference between saying do it if it's ESG to say how it impacts and how that could be changing the way that you invest. So that's going to come into place next year. We're expecting to see a kind of a huge wave of pension schemes figuring out what they need to do in that context.
Okay, thank you. And before moving on to integration, A3, I'd like to ask you about engagement. That successful engagement on ESG issues can clearly lead to pretty significant financial gains if companies improve their performance on ESG factors. But how do you identify which companies to engage with on which issues?
Well, actually, it's relevance or materiality and transition are, I think, the two words are the names of the game. What you should do is you should identify those topics that are really relevant for the business model and for the specific products and services some companies are doing. For instance, in the mining, you should really be aware of the accident rate. For food companies, product safety, if there are some controversies around it. So then it becomes identifying risks and opportunities in the companies that you are holding or want to hold, that you identify those risks and opportunities, and then you should ask the questions about it and engage with them to either be aware how they look at it. Is it just an incident, or is it something which is structural? Like, for instance, with the diesel car scandals, it was not one car or not one car maker, but it was broader in the market. So then you become aware in which sectors some issues may be appealing, may be prominent, and also may be important for the selection of your portfolio. As we are an active investor, which we select not just an index, but we select which companies we want to invest in. For us, it's extremely important then to really understand the companies that we own and to really also take into consideration what are the risks and opportunities, and helping them also understanding that their risk is our risk or our risk is their risk, because we own them. We are part of their financial market incentives. And just to add to what Mariam said, to me, ESG factors are financial. It's simple as that. There's no but. It is financial.
Okay, thank you for that. Let's move on to integration, ESG integration itself. Now, this slide is from the CFA and PRI, from one of their documents on ESG integration. You'll be able to download this, and we'll include a sort of full source so you can see it more clearly. But essentially it identifies three levels at which ESG integration is done, and we can talk about all three of those. Firstly, the research level, which is the inner core. Second, security level valuation, which is the orange middle core. And then the outer core, which is at the portfolio level, where there's portfolio construction, asset allocation, and risk management. And this is more of a menu rather than a process as designed by the CFA. But starting with research, I'd like to ask you, Richard, how you carry out your security level research. You've mentioned, I think, Sustainalytics, and or that's been mentioned, but do you use external research, proprietary research, or a blend of the two?
Yeah, Justin, most of what we're doing really is coming in-house. I mean, as you look at Robo Global, we really are a research shop, and that's what we spend most of our time doing. And I think, we realized very early on as we looked at this theme, it was going to take a very different type of coverage. This wasn't about just going out and grabbing a database of companies and applying some financial metrics and, voila, there's your strategy. What we need to be doing here is looking forward. We need to be meeting these companies. We need to be understanding the technology, but sort of driving the opportunity forward. We need to find areas or solutions in the market where we're successfully seeing, robotics products being deployed. So what we did very early on, and we've continued to build this team out, but we've aligned ourselves with some of the world's leading robotics experts and entrepreneurs. We've got 7 of them in the group at the moment, and that group help us to look forward. They help us to understand the technology, where it's being deployed, and they help us to open up doors. So, again, we've got very good access to all of the companies in our strategy as well as a broader universe. We have regular meetings with each of them, and that really forms, the sort of the bulk as to, how we will make informed decisions and apply these quality filters, including the ESG policy.
Thanks, Richard. And Miriam, can I ask the same question of you?
Yeah, I mean, so the different levels of research that we buy. So there's sort of different ways of integrating ESG depending on the types of strategy that we manage. So we have about half the assets in index, the other in active. We have equities and fixed income, so that's all different. For index creation, the types of research that we buy is very much looking at what we need in terms of the data points that help build a healthier market and the companies to function better. And so we kind of focus in on 28 raw indicators that we bought from external parties that we believe are absolutely vital to make sure that thousands and thousands of companies in the market are adhering to the minimum standard. So that's what we've done for the index context. And then for active, it's a little bit different because you're trying to obviously stock pick, whether it be on the credit side or the equity side. And that's really about looking at the materiality of each of the sectors and picking things that would distinguish one company from another. And that meant that basically the analysts, credit analysts and equity analysts kind of really hone in on those sectors and figure out what is important. So there's sort of different ways of doing ESG integration in that sense.
Great. And A3, do you have anything to add in terms of doing things differently?
Well, maybe not differently, but what we at least see, if we buy research, ESG research, we use it as data, as input, not as an outcome. So we use it as data, input for our own process, our own assessment, our own analysis, and then we come to a conclusion. We even have built in what we call a engagement council, in which we use this material and relevant ESG data point to discuss, is this something that we need to engage the companies on, yes or no, where only analysts are discussing this amongst each other. And it gives a huge leverage in the conversations and also into the potential positive outcome of the discussions. So research is important, but it's input, not outcome.
Thanks for that. And we're going to come on to talk about data and disclosure later on, so I think that's an important point. Now, looking at the second level of ESG integration, valuation. Now, I know you're probably not going to agree with me here, Miriam, but I think that, or I put forward, that does incorporating an assessment of ESG factors into valuation become inherently more difficult unless you have stranded assets or some very quantifiable element. And here I'm really thinking about materiality and data quality and data history, etc. Could you explain how you do this at LGIM and perhaps give an example?
Yeah, I mean, on one part I absolutely agree with you. On the other hand, I don't, and let me break those down. So the part that I agree with you, yes, it is difficult because the disclosure from companies is patchy at best. We don't necessarily get really core data. And let me give you one example. If you talk to a bank and you say to them, what is the most important, asset to you? They would say, our people. Obviously, banks is all about the people. It's not about the machines. And yet, if you say, well, what is the indicator or data or information that tells us how well you're functioning, your workforce is, or there's nothing really there to work with. So, of course, in ESG, there's a lot of the unknown, and that's a difficult part of ESG. But the second part where I don't really agree with you in that sense of it is that that's what investment is. investment is not investing on things that everybody knows about, and you don't need people to assess that, right? To a large extent, you really dig into what companies are doing, what the sectors are doing, and then try to find sort of the risks that haven't been priced in. And so I think ESG is as difficult as investment in that you are making an assumption. For example, if you look at a company that hasn't got good governance, well, we're not necessarily saying that they're going to do badly in the future, but it's a very good insurance to be buying now when things are functioning well, because obviously when the company does really badly, well, it's too late to change the governance. So we have to see ESG as a way of, sometimes a proxy of well-functioning companies for which we don't have perfect data. But again, that's what investment is, and that's what we spend a lot of time looking at. Data, information, we talk to companies, we engage with them, and we obviously ask for more disclosure so that we can analyze better.
Thanks, Miriam. I think that's a fair point. I think it possibly begs the question as to why it isn't done more consistently, I think, in many places. But because it is, as you say, it's part of what the job's about in valuing stocks. But I think that's changing. Now, A3, I'd like to ask you a question on different asset classes. It's very easy to talk about ESG and equities, and it's arguably much easier to incorporate ESG factors into the investment process for equities and credit, even though coverage is poor for high-yield bonds, say. But for government bonds, I think it does become more difficult, especially for the E. So could you explain how you assess ESG factors for this asset class?
Yeah, it's a good question, and I guess many viewers have this same opinion. In my opinion, actually for every asset class, remember what I said about previous remarks about relevant and materiality, and how can you look at transition. For government bonds, it's important that you look at how does a country make sure it generates enough income, mostly tax income or other incomes, to make sure that it repays its debt and can grow and thrive as an economy. And for that, for instance, you look at education expenditures, you look at infrastructure expenditures. So if a country has good infrastructure, good digitalization for the future, I mean, that's the things that you need. So if you give countries a sort of positive extra notch up or maybe a notch down in your valuation models, if they do properly invest in the right things for the future, that already is in a sense taking ESG into account. Because again, education spending is ESG. How do you go about with certain investments? You talked about environmental. Does a country sell all its trees and all its mineral resources just to every first buyer, or is it a bit smart and does it get more back from that than just only temporarily income? Those are the things that are of influence for evaluating and taking ESG into account. Of course, corporate governance, translating is how does the country is being governed, democracy and stuff is also very important. But specifically on the E and S, there are more things that people could ask or look into before making a investment decision, which country to overweight and which one to underweight.
Okay, that's well. Moving on from that, Adrian, I'll also ask you, if we then turn to the portfolio level, how do you then use your ESG factors in your decision making in terms of the actual investment choices, and in particular for asset allocation?
Well, I think it's the asset allocation. It's much more than on the more detailed level. That at the end you try to make that, like I said before, ESG is financial material. So you bring it into your financial valuation, and so you give over and underweight, and so you give preferences. So you say, well, some notches up and down in the credit rating of a company or an issuer in that case. So in that sense, ESG criteria do play a part in the investment case and do play a part in your scorecard, and then you can construct a portfolio. It's not the case that you just say, well, ESG is important and I have the same portfolio now as if I wouldn't take ESG into account. To me, that's a bit strange.
Okay. Okay, thanks. Richard, negative screening or a thematic approach can avoid some of these difficulties by not focusing on valuation, but does that, or making valuation just one of the choices, but is it then more vulnerable to sector and regional biases?
Yeah, well, look, Justin, I mean, I can only really answer that from a sort of a robo perspective. I mean, I think the short answer there is no. You know, as I said earlier, you know, we employ these quality filters. You're right, we don't have a valuation threshold as part of that filtering process, and that was very deliberate, because if it was there, we would obviously have to adhere to it. And, you know, the reason we don't have that is because we're dealing here with an opportunity where there's a lot of new technologies at play. We're looking at machine vision, navigation algorithms, we're looking at pretty, you know, complex solutions. We're looking at surgical robots. We're looking at precision ag on farm. So, you know, this is all about being forward-looking. We're looking really for tomorrow's winners, and you know, there's a lot of diversification, and that's very, very deliberate for us. And I think that overcomes a lot of, you know, as you're saying here, sort of, you know, regional biases or sort of cyclical type trends. I mean, we strongly believe you need very diversified access to this theme. It's too early to take concentrated bets. It's too early to try and time it. You just need to, you know, look forward and have very diversified exposure to the theme.
Okay, thanks, Richard. And Miriam, I know you've touched on performance and risk and return attributes from your new range of funds, but I think this is a really important issue. And probably more wide than your funds, because historically, most studies, I think, have shown that integrating ESG doesn't damage returns, but neither does it enhance them, although it may improve risk. However, studies showing more recent data, focusing on them, seem to show that a focus on ESG improves both risk and returns. What do you think are more generally the risk and return benefits of an ESG focus?
Yeah. First of all, I think when you're looking at any kind of data, you know, returns, because of my very first point of that there are so many terminologies, you are comparing apples and pears and bananas and all sorts of fruit in a basket, as opposed to really looking at two comparable funds and how they, you know, differ from each other. So I think there's a little bit of a caveat there. I think, like with any investment, you can do it badly and you can do it well. And I think that's also true of ESG. What I'd like to say about looking at historical data going as opposed to going forward is that ESG is going to look very different from today, in 5 years from today, compared to 5 years ago. 5 years ago, we really didn't have a lot of consistent data. We have a lot more data today, and we will have a lot more data. And with the likes of robo-advisors and so forth, you know, we're going to have far better analytics. And we're also going to have very different consumer behavior choosing this type of funds, or perceiving companies differently because of what they do and don't do. So I think there's huge amount of forces that are coming in, which means that the risk-return profile of the companies will you know, likely to change in the future, and so it makes sense to be future-based when it comes to ESG. One thing I'd like to say, which I don't think we talk about enough in ESG, is the risk of not addressing some of those issues. And I think climate change is a perfect example. If all of us fail to address, you know, climate issues, energy transition issues, we all fail together as a market. You might not have underperformed by your peers, but you're none the wiser. So I think there is an element of the fact that there is an inherent risk in inaction. And that's what we try to do with our philosophy of engagement with companies, pushing regulators, but also the likes of Future Water Fund, and sort of say the default, the central decision of investment has to incorporate the really big societal things that we need to address, and we think that's financially the right thing to do, but also if we fail to do that as a whole market, then we all lose out, so let's address this. So that's kind of a slightly bigger point of ESG, but it's an important one.
Absolutely, and I think that's what we're going to come on to at the end exactly, because I think the world looking forward is very different, and this is the question I kind of asked at the beginning, which is does ESG miss the point to some extent as it's done now? But let's come on to that later. Let's look at data and disclosure, where I think we've mentioned some of the issues here, that this is the largest maze in Europe, I think, where there have been significant issues, in particular about coverage and the quality of disclosure. Now, Richard, do you think this is improving, and what can we do to mitigate it? What can you do?
I think it's certainly improving, and I think even before you just zoom in on ESG disclosure, I mean often just general access and understanding of companies can be a challenge. I mean again, just from where we sit, we've got 75% of our portfolio are small and mid-cap companies. These are companies spread across many different geographies. Some don't have any analyst coverage today. They are not known by the financial community. So just general access and information about the companies can be quite hard to come by, and that's before you even start to think about applying any sort of an ESG policy. So I think as an investment community, we've just got to continue to push for more transparency, more disclosure. In the meantime, for us, it's about having direct access to the companies, being able to sit across the table and actually talk to them and actually understand more about the business and how it relates to the robotics and AI theme.
Thanks a lot. And Adria, I'd like to ask you about supply chains. Do you think there are particular issues about monitoring and assessing these when it comes to ESG considerations, because they're so complex today, and I'm talking about supply chains at the company level?
Yeah, and indeed, supply chains is one of the most complex things, because all these things might happen between, for instance, you have a short supply chain or a very long supply chain, depends on the complexity of your product. One of the things that, for instance, what we in the Netherlands, there also has been recently a collaboration being announced, of which NNIP is part, of course. It's called the Living Wage Platform Financials, which is that to address issues in the global supply chain, we look at how workers are being paid. Because if workers are being paid properly, for instance, in the footwear or even in some agricultural supply chains, it can already help to rule out some issues. For instance, if you as parents get enough salary from your work, you don't need to send your children also to the farm, or you don't need to send your children into the factory to make shoes for a certain sporting goods manufacturer. So what you try to do here is not simplifying it, but trying to get emphasis on certain parts where we still can empower companies to take their own decisions, and where we can engage to make things better, and where we think this is a leverage for solving several issues into the supply chain. But it is complex, and living wage can help steer into the right direction, and it's a good step, and especially because 7 big asset managers in the Netherlands work together on this. So then you can really have impact.
Thanks, Atri. Now let's move on to the future, which, as Miriam has pointed out, is really what it's about. Now, most investment companies pursue sustainable agendas at the corporate level, but they don't invest in sustainable companies as such across most of their funds unless they have an explicit ESG tilt or impact funds. Now, Richard, looking forward, do you think this gap creates a problem? And with the implications for climate change worsening and so the risk going up, does ESG integration, as it's understood, go far enough?
Yeah, I don't know if it's more of an opportunity, versus a problem. Some companies are going to be a lot better at this. As I've said several times, we think from this, robotics and AI theme, there's a lot of benefit to society and investors, and there's a lot of a natural alignment to it. So yeah, we're clearly in a world that's moving towards this, and the benefit for investors as well as the companies involved in it themselves.
Thanks. And Miriam, can I ask you the same question? do you think ESG integration goes far enough?
You know, because I'm so deep in it, I always think there's a lot more room for improvement, and I think it's important. I mean, particularly the social issues definitely is not really addressed at all in a lot of the contexts, and there are so many environmental issues as well that we haven't really tackled. I do think there's quite a lot of gaps still to be filled, and then the gap also comes from where the market, and I think this might be what we're trying to get to the crack of, to the bottom of, which is is the demand real? Are people really going to change investment choices on the back of this? Are the managers going to be rated differently? Are people going to choose differently for their pensions? And if so, we're more likely to have a lot more energy resources put into the space. And even though there's a lot of positive signs, there's a lot of hesitation in the market today. And I think that's probably fair to say. Are people willing to pay a little bit more for this? Are people really wanting to make that difference? And even though there are a lot of encouraging signs, there is a lot that, kind of traditional trustee base think, oh, it's just a nice to have, it's not really worth it. So there's a lot of things that we're kind of banking on, which has to come into play, which is better data, better information, but also consumer behavior, some pressure from regulation, as we talked about earlier, and whether people's choices are going to change. So those are the things that would even drive integration to be much further, I think, in the coming years.
Thanks a lot. Now, if we look at now, again, this is difficult to see on screen, but there's a growing perception that we're facing some strategic disruptive changes, which can be grouped together as technology, climate, geopolitics, demographics, but which are all interrelated. And what this slide shows is a version of these trends and risks, which is produced by the World Economic Forum as part of their Global Risk Report. Now, these have potentially transformational implications across the global supply chain, leading to big risk and opportunities. So, Richard, do you think investors are currently integrating an assessment of these broader megatrends into their portfolio, of which the E and the S form a part? And if not, should they be? And if so, how?
Well, personally, I certainly think that they should be. Since we started the Robo Global journey, we continue to do almost a lot of education in the market, just sharing with investors how this robotics and AI theme is actually unfolding. How it impacts society and companies and in individuals, and what the sort of underlying sort of investment opportunity is there. So I think we've moved in the right direction, but I think we've got a long way to go yet. I mean, we spend a lot of people understand the opportunity here from a pure investment perspective, but where it then actually fits into their strategies is another question. And if it doesn't fit nicely, then they tend to say, well, we'll come back and have a look at this further down the road.
Great, thank you. And Miriam, do you think this has any implications for how we're going to integrate ESG in the future?
Yeah, I mean, absolutely. So those themes like demographic trends, particularly aging population, energy transition that's closely linked to climate change, and technological advances, those are the big themes that we're addressing as a firm, which basically lead to the way we allocate assets, to a large extent pick stocks already. We are long-term investors, so those are the things that we have to be really looking at. From my perspective, particularly on climate change, and I think there is a research done by World Economic Forum which ask younger people, so-called millennials, what do you think is a top risk? And I think the research came back for the last 3 years, consistently at the top is climate change. And you said in the opening in terms of the IPCC report basically saying that we need to really be limiting the temperature increase to 1.5 degrees as opposed to 2 that people are saying that it's already difficult, but the current trajectory is 3 to 4 degrees. I mean, it's completely off where we need to be heading. So, I mean, we talked all about the fantastic, effort that's going into place, and I think, in terms of this kind of research showing us a real risk to societies globally, economies, and therefore obviously their investments, all of which are absolutely linked, we do need to go a step further. So I'm very determined to make sure that the mainstream, the trillions of money that are moving around, is not financing things that's going to, compromise our future. And I want to say, with all the innovation, analytics, data, and engagement that's happening into place, this is already possible to create a portfolio that really addresses something as big as climate change. It's not going to solve every problem, I'm not going to promise that, but I think we have that solution today. And so I really want to show that this is something that's available today. People should be choosing. If not, it should be your choice, and then if you don't want it, you opt out. And then you should be absolutely pressuring your managers to give you, the best option that's aligned to what you believe is the right thing to do for your future.
Okay, yeah, I'd agree with you absolutely, and I think my own view is that the way in which we do research at a company level is going to change in the years to come. That these disruptive forces are so significant that they're probably not currently being taken account of sufficiently. Now, we've got some questions from the audience, so I'll move on to those. The first of those, I'll ask you, A3. In addition to a focus on sustainable development goals and thematic impact investing, what are other major trends in sustainable ESG investing for the coming years?
The interesting trends. Well, I think one of the trends is what I mentioned with the platform living wage is two things, is collaboration. So not just individual firms pursuing their own way of looking at this, but also seeking collaboration and doing things together. You already see that, especially on climate change, and the IIGCC, the International Investors Group on Climate Change. There's a lot of collaboration, just as Miriam explained. That's one thing I do see, and that you pick out a topic like living wage, and you can connect that, just like the spider you saw on the screen. You can connect that to other things because things are interconnected, and I think that's one of. It's not a trend. It's something that we should do. I mean, a trend is something that we hope for, and but this is how we should act. It's about that. And that's the second thing, acting. So we've done a lot of thinking and contemplation. Now it's time for acting. Awareness is there on ESG. Now let's act and put our money together and make it work.
Thanks, A3. And another question from the audience, and I'll ask Richard, I'll ask you this one. At a portfolio level, what are your thoughts on short positions, i.e. should you short poor ESG stocks and go long strong ESG stocks, or should you just avoid any position with poor ESG scores, long or short?
Interesting question, especially as, we take a very sort of, broad, diversified, view of our particular theme. I think our view is that we avoid companies that don't pass our ESG policy. I mean, we don't within our strategy actually short particular companies because of it. It's just as we talked about earlier, it's an exclusion type position that we will take, and we'll remove them from our database, and hence the index strategy.
Okay, thank you. And Miriam, a question on a slightly different switch on the sort of performance question, which is, even though there are ways to reduce ESG performance drag through active selection, have you estimated how much the increased ongoing monitoring requirements might cost an investor in comparison to traditional vehicles? Should an investor expect to see the cost in AMC or in performance?
Yeah, really interesting question. So, as I said right at the beginning, I think ESG is becoming the norm. I mean, I would think you struggle to find a manager who claims not to ESG. So maybe, in terms of, there's nothing really much to compare to in terms of traditional versus ESG. But let's say that you will get extra reporting. You get sort of extra choices. You get extra sort of bespoke mandates and things like that. And yes, that could come in at a cost. Now, it might be, depending on the strategy, asset manager would say, well, that's our IP. That's what we're going to give it to you. So we're going to just include that in our normal fee, and you don't pay anything extra. And I think you can expect to see that in a lot of the cases, especially if you're saying that those things are financially material anyway. But let's say, you're looking at an index, which is, you have your market capitalization based index versus slightly ESG tilted. Now, there is a little bit of cost in that because you are buying data, and the data is not cheap. You are doing quite a lot of analytics on it, and you are probably going to get extra reporting on the back of that as well. But we're talking about an extremely, really small change, and it shouldn't be a huge difference. And obviously, when it's an index, it's already a fairly cheap option. So it's not significant in that sense. But I think the question gets to the core point. It's like, it's all nice to have. Are you willing to pay a little bit? And I would say it's not about, as I said, whether you pay more, but what is the cost of not doing it? If it's saying that it's financially material and it helps with your future, then, as I said, this seems like the right choice to make. But it's one that is a much harder conversation with trustee-based. I'm finding sometimes.
Thanks, Marion. And another question from the audience. And Richard, I'll ask you this. Most research seems to suggest that ESG is inherently multi-factor and correlates with quality, low vol, and size. What are the challenges or benefits this creates when implementing an ESG tilt?
Yeah, I think I think one of the biggest concerns, as Miriam was just sort of addressing as well, is how do what's the cost? How does this actually impact performance? Certainly, as we look at the profile of the companies that we've got in our portfolio, we would certainly describe them as you are here as high quality. I mean, they're profitable, they're well established companies, they've got good business models, and that's why we've got them in the strategy. And yet they do have this, as we said earlier, this very natural ESG tilt. So I would kind of agree with the statement. We don't see it as a challenge because, again, as I said, we've really reverse engineered ourselves into this. I mean, we like this investment theme because it is aligned to ESG. We think that's a growth driver. It's a returns driver. I can give you a really simple example. Every year there are 1.2 million fatalities because of car accidents, and 95% are from human error. Now, we've got 12 companies in our strategy that supply technology and product into the autonomous car industry. I mean, if you can halve that number of fatalities by employing some of these sensors and this basic technology, that's a great outcome for society as well as for investors.
Great. Can I ask you, now we've gone through most of the audience questions, do you have any last thoughts in terms of takeaways from ESG as we look forward? And I'll start with you, Mariam.
I think one thing that I am excited about is increasing research showing that, everything else almost being equal, people do want that so-called sustainable option. And sometimes we get stuck with academic discussions about past performance, data, regulation, all this kind of stuff, and rightly so. But at the end of the day, if you can come down to, if you could say to somebody, it's like, look, this is the one that addresses something as big as climate change, and it's a manager who's going to really step up and speak on your behalf, and this is the other one, which is basically the same return, whatever, and it doesn't, I think I think the research is becoming very strong that people do want, not everybody, but a good number of people are choosing that. So I think we have to shift the conversation sometimes away from what can we do as an investor to what can individual do as choices.
Thank you. And A3, could I ask the same question of you?
Yeah, thanks. Yeah, a bit slightly different answer. What I see for the future, and I see that already starting at several points, is that we move away from building portfolios by accident, but just putting together in a basket companies and issuers that we deem sustainable or responsible enough or tick all the right boxes, but we go to a more sustainable portfolio with holdings instead of a portfolio with sustainable holdings. So there's a general idea about sustainable development. Where do we need to go to? What's the future outlook? And that you then look for the right stocks and issuers that fit in that portfolio, and not just by accident it is in the same basket. So it's much more a common, general, genuine accolade of where should we go to? What's the future holding in spare for us?
Thank you. And Richard?
Yeah, we spend a lot of time sort of, moving globally between different countries, and, we are encouraged by, a lot of the narrative and actions that have been taken, certainly in Europe. It feels like we're sort of, ahead of the curve here, but yet, I'd agree with what Miriam and Atri have been saying. We've still got a long way to go. Are we doing enough? No. But I think what concerns us is just how far behind almost we are in other parts of the world in terms of really embracing this as a sort of a guiding sort of investment criteria within strategies.
Okay, thank you, Richard. Yeah, perhaps that creates opportunities from an investment point of view. I think my last thought would be, I almost hope we get to a point where, we stop talking about ESG, that these become seen as so embedded and integrated within our approach to portfolios that they don't get classified and therefore to some extent sidelined. We can, although climate change is a controversial issue, climate risk is not a controversial issue. And we need to start addressing some of these points. Now, I think our time is over, so thank you very much to the panelists, to A3, to Richard and to Miriam. I hope people have found that interesting. I certainly have. And I know that we'll have some data downloadable, the presentation downloadable. Thank you very much, and good afternoon.
Good afternoon.
Thank you, bye.
Bye.